as we get ready to talk mortgage rates ahead of this announcement on interest rates from the Bank of Canada. No move expected on Wednesday, but it will be interesting to know what the Bank of Canada sees ahead. Clinton Wilkins joins us now. Clinton Wilkins' mortgage team, Centum Home Lenders in Dartmouth, Nova Scotia. Hi there. Welcome back.
Thanks for having me.
And I'm guessing that you're not expecting any earth-shattering news from the Bank of Canada on Wednesday, Clinton?
I think they're going to hold steady, but I think every Canadian, every economist is already waiting for the day that the rates are going to start softening. And I think they're going to really start softening in the near future. I think originally the economists were thinking that things would start softening, midway through next year. We're talking maybe June and July. We're going to start seeing the rates go down. But there certainly is some downward pressure now, and I think maybe even by the springtime we might see some signs of softening. Obviously some good news around inflation that we had been announced, and interestingly enough, with the bond yields last week, certainly some pressure on the fixed-rate mortgage products as well. We're seeing some softening, and I think we're going to see rates lower in this very near future.
Okay, so, let's talk about some of the rates that people can expect if they're out shopping for a mortgage or are up for a renewal on their current mortgage. Give me a sample of some of the rates that are on offer right now.
I think all the rates are currently high, and I think that's what you really need to think about. Most commonly Canadians take a 5-year fixed, but that certainly wouldn't be what I would be recommending right now if someone can qualify or have the risk appetite to take anything else. With a 5-year fixed, it will be the lowest rate, so I think that's what we need to remember. And you'll be looking at rates anywhere from 5.5% to low 6% range. There certainly has been an increase of popularity in variable rate mortgages even the last few weeks as, we've had more, positivity thinking about having rates go down. So variable rates certainly have taken uptick and certainly more popular than they were even a few months ago. So the one thing that we're always telling customers is if we're expecting the rates to go down in the future, we need to think about either doing a shorter-term fixed, and I would say right now a 3-year fix is the most popular, or if you do have the stomach, I think a variable rate will treat you very, very well in the future, but you just need to have that appetite to be able to hold on for these rate decreases to come.
So it's interesting that people are kind of hedging, right, with your 3-year being your most popular product. Mm-hmm. That's very interesting.
They're certainly hedging the bets. I would agree with you 100%. But the one thing that you need to remember as a consumer, a 3-year fixed is going to be more expensive. And, the banks have this figured out. We know where the popularity lies. And, historically, that 5-year is going to be the most popular, and it's the lowest rate. And I think many consumers are tempted to have the lowest rate product. But we need to remember, lower is not always better. And you need to really think about what your situation is. So many Canadians are breaking their mortgage early, and as you can imagine, if you're breaking a mortgage, let's say even in a couple of years, and you're breaking a 5-year fixed, you could have a very significant penalty to get out of that term early.
Okay, what about high-ratio mortgages versus low-ratio mortgages? What are you seeing there?
In Atlantic Canada and the prairies, certainly a lot of high-ratio mortgages happening. So that would be when you buy a home and put down less than 20%. You'd need to get the insurance from the Canadian Mortgage and Housing Corporation, Sagen, or Canada Guarantee. Maximum amortization would be 25 years, and they're financing owner-occupied properties or second homes. We're also seeing a lot of popularity with mortgages that are being financed at 65% of the property value. This might be on a renewal or on a purchase, again with a 25-year amortization, but lenders can get what we call an insurable response. So you're not paying this high-ratio insurance to CMHC, but the lender can then access things like the Canadian mortgage bond and still get very aggressive rates, and oftentimes the rates are as good on an insurable product as they would be on insured. And just to give you a little bit of an idea about what the rates look like, when I talk about fixed rates on a 5-year at 5.5%, that is on a high-ratio insured or an insurable response. If you want to get a conventional mortgage, we're talking rates typically above 6%. So there certainly is a spread between a normal conventional mortgage and, a high-ratio or insurable mortgage.
Okay. And just to kind of tie a bow on this, you would expect mortgage rates to begin falling when?
I'm seeing some softening this week, just due to what's going on with the bonds and how the bonds have softened. We certainly are seeing some fixed rates that are lower this week than they were last week. I think for us to really see some big decreases, we're likely looking into the spring and summer next year.
Okay. Very interesting. Thank you so much for your expert insight. Really appreciate it again, Clinton.
Thanks for having me, and we're really going to be staying tuned here Wednesday for the Bank of Canada announcement. I know a lot of people are kind of waiting with bated breath. I think, obviously, being in an environment that even the rate is maintained, people can start planning, obviously, for the new year.
Thank you again. Clinton Wilkins, the Clinton Wilkins mortgage team sent him home lenders in Dartmouth.